Welcome back to another episode of Real Talk. Christian and I are both brokers on the Crotty Group here based out of Lakeview in Chicago. And today we want to debunk 10 myths that we hear all the time as buyer's agents from potential clients who have hesitations about getting into the real estate market because of one or more of these 10 myths.
Definitely. So we'll dive straight into it. We won't waste any time here, but we'll start with the first myth. And I hear this a lot with a lot of clients, thinking that they need 20% down or 20% for a down payment.
It's definitely a myth, 100% myth. I would say of my last 20 buyers that I had, probably only 8 of them actually did 20% or more down.
Yeah, I also have this conversation a lot. A lot of people think that you need 20% down because that's just what people have heard just in the past. But in reality, you could go as low as 5%. A couple of things to consider though, right? As we head into a little bit of a crazier market this spring, a lot of people like to see stronger financials, and that may require a little bit higher on the down payment to show and have some confidence or give confidence to the seller that you have the funds to close and that you're very motivated. From my perspective, you don't need 20% down. I didn't go 20% down on my purchase just because I knew I wanted to use up the extra funds to renovate my home or invest in other opportunities. And so at least for me, I don't think you really need all the 20% to purchase a home. It is a great way, especially in a competitive market, to show that you're highly motivated.
Right.
But
it makes your offer stronger.
Exactly.
And if there are no multiple offers, a lot of times an offer with 5 or 10% down at the right price is still just as attractive to the seller as 20% down.
Exactly.
But as a buyer's agent, I'm telling my clients, listen, if you don't have to tie up an additional 10% in this house, because once that down payment's in, that's tied up in your equity in your home, and you can only get that out if you cash out, refinance, or HELOC or some other thing. Why overinvest?
Exactly.
There are other implications. You'll pay private mortgage insurance. Your monthly payment will be higher. Your interest rate may be different. So definitely talk to your lender when determining how much you want to put down.
Exactly.
How much you're comfortable putting down, and how much your finances will allow you to put down. To your point, if it's a competitive situation, putting more down certainly makes your offer more attractive.
Hopefully this helps with people who are stuck thinking that they need 20% down. You guys can get into homeownership a lot sooner than you think. So
on that note, for those would-be buyers out there who have believed this myth, they're diligently saving for 20%. Typically, if they're not living at home, they are renting. And that gives our segue to myth number 2, that renting is always cheaper than buying. It's just like regurgitated so much. I think people honestly just believe it now because they hear it so much. So tell me why that's not true.
Me personally, I've always hated the idea of renting and paying for someone else's mortgage. And just to give you guys some insights into my personal finances right now, I purchased my home not too long ago, about a year ago actually, and I pay less than the medium rental in here in Chicago. So renting can be a little bit less expensive if you find the right property. And in this situation now, with rents going really very, very crazy expensive, it's not always the right move in my opinion. You can get into homeownership with like we just talked about, little down, and your mortgage payments can be lower than the average median rental price. But my thing, was the fact that I was paying for someone else's mortgage and making them richer and increasing their equity. And so maybe some of the costs that people think about, the down payment, the closing costs, those are the upfront costs that you
your
pay
initial
upfront.
investment.
However, in the long term, you're building more equity, you're going to become more wealthy, and in the long term, it's just always the right move.
When people say it's cheaper to rent, it's a little short-sighted. Sure, your monthly payment may be $100, $200, or $300 different between a mortgage and the rent, but cheaper in the sense that you're not investing in yourself. You're giving, to your point, your money to a landlord, and 5 years down the road, you don't actually have anything to show for it, except at least that's about to expire. And a move looming out in the future. With that debunked, you don't need 20% down. Renting is not always cheaper and usually not than renting. I hear a lot of times our third myth, that your credit score
Yes, so
you
then
need
you
a
need
perfect credit score
yes.
in order to get approved for a mortgage, and that is definitely a myth. Your score does impact the interest rate you'll pay and the type of loan products you can get, but it's not a black or white scenario where you're approved or not just based on your score. There's a lot more involved in that.
There's a lot of things to consider too, right? If you're looking to invest in a property in your first purchase, please consider talking to a lender, reaching out to a lender, as well as your real estate agent. But maybe talk to a lender to see what their thresholds are for what makes a good credit and what could significantly lower your interest rates, right? That's one piece of advice that I would give to everyone who's looking to purchase. Before you actually pull your credit, maybe talk to a lender and ask for what that threshold is. So that way, if you do have that flexibility, maybe you give yourself a couple months to figure out that situation so that you can ultimately lower your interest rates, right? But even then, you don't need a crazy high score to get into homeownership.
Absolutely not. And speaking of credit scores, it's myth number 4 that you can't buy a home with student loan debt. It factor into your credit because it's a debt that is going to show up on your credit, but that doesn't automatically disqualify you.
Exactly. And so when the loan officers are looking into your financial situation, they look into your DTI, which is your debt to income ratio, right? And that DTI determines what you can afford. That DTI, usually they want to see, what was it, like 40 to 50% a DTI in terms of some, so that you can qualify for.
Yeah, on the high end, it's usually 40. They prefer to see somewhere around 30% of your income going to your debts versus your housing.
Yes. And definitely something I recommend, right? If you have flexibility and you want to make sure that you're not just getting into a home and being house poor, definitely try to stick to that 30% mark in terms of DTI. But, when you have student loans, they are not going to consider the whole amount. They're only going to consider what you owe per month. And so that's going to affect your DTI. So just because you have student loans,
they look at your minimum payment every month. And I, always check with your lender. We're not loan officers, but this is just from our experience working with a lot of first-time buyers or repeat buyers who have student loan debt. So let's say, you got pre-approved, you decided not to keep renting, you're not going to do 20% down, you're out house hunting. We hit another myth all the time. You see a house, it's listed at, let's say, $200,000, and the buyer is like, well, I just have a personal stance where I've been told all my life you never pay over asking price.
Yeah, that's definitely a huge myth. I think there are certain situations where there are opportunities to go over asking, there are opportunities to go under asking, there's opportunities to just go at asking. Let's look at some of the scenarios, right? When to go over asking? If it's a hot market like we are going into right now, especially if it's fairly priced, and talk to an agent to give you guys a little bit more insights on whether a property is listed correctly in terms of price. In that situation, with the amount of demand that we've seen recently, maybe it's something that you got to consider to get into homeownership. But if a property has been listed for a couple of months, this is when you have a great opportunity to get an investment for a lot cheaper than what they're asking for. A lot of the times, a lot of agents don't price their properties well, and so you may be able to get a discount, I guess, per se, on the property.
The listing price is a number that the homeowner and the listing agent together usually have come up with. It's not something that you should take just at face value. As buyer's agents, we do a lot of research on comparable sales. Just because it's listed at that, it could be below market, it could be at market, it could be way over market. It's definitely case by case. So those are our top 5 myths that we are covering today. Definitely join us next week as we cover the other 5 top myths that we can't wait to debunk for you. So be sure to like, follow, subscribe. If you have other myths you want us to talk about, definitely reach out and let us know. Thank you so much, Christian.
Of course,
and we'll catch you here next time. Okay, funny man.
How do we